And on today's show, why understanding mortality mechanics can improve your practice. Part 2 of this week's series on product due diligence with nationally recognized product due diligence expert Barry Flagg, CFP, CLU, and CHFC. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician and InSpot. Let's get down to business. Well, welcome to day 2, Barry.
Thanks, Steve. Glad to be back.
Well, we're talking to the doctor of due diligence and all that is due care in our product line, and we really want to talk about some of these things. I mean, I was shocked at a conference that I was at not too long ago, about 9 months ago, where I actually spoke on due diligence and asked anybody in the audience who had actually seen an in-force ledger in the last year. And when nobody raised their hand, I was stunned.
Really?
Then I'm thinking, well, did you do a policy review? And when you saw that policy review, did you actually examine the annual statement? Maybe there's another place to go.
Absolutely.
Did not see it. When I said, then did you look at the client's proposal? Yes, they did do that. And when you looked at the proposal, were you comparing it from proposal to proposal? Now, if you missed yesterday's show, you'll understand why I asked this question, because Barry says, hey, this isn't due diligence, just comparing, illustrations to illustrations. So I'm surprised that we're not using some of the things that are absolutely free. Carriers will generate it and it'll help us get in the game. So talk a little bit about the use of annual statements and especially in-force ledgers.
Some say that I've got a predisposition against illustrations, and that's not the case at all. I mean, illustrations are one of the essential tools in doing due diligence. In-force illustrations or illustrations in general are useful for calculating funding requirements, for including cash flow projections in an estate plan or in a financial plan. And these illustrations also include inside, not necessarily the first one you get from the insurance company, but if you ask for it, you'll get their actual pricing representations, which are also included and can be reconciled with the annual statement. So comparing a hypothetical premium to a hypothetical premium or hypothetical cash values to hypothetical cash values, to me, I've been in those kind of sales meetings where the producer says, the only thing I can tell you about this illustration is it won't come true. And so we're going to take one piece of paper that we know is not going to come true, and we're going to take another piece of paper and it's not going to come true. We're going to compare them to figure out which one is better, but they're not true.
The lesser of two evils?
The lesser of two evils. So the in-force illustrations and the new business proposals contain some very valuable information that can then be measured in the way that CPAs, tax attorneys, and trust officers measure every other asset in the estate plan, every other asset in the financial plan, and every other asset in their stewardship.
So if we're really incorporating, and most good advisors are into doing annual meetings with their clients and reviews. Before that review takes place, if I have life insurance as an asset, especially if it's an income asset that's supposed to generate, I would say that in-force ledger is mandatory.
Absolutely.
So I liked your thing about comparing the two. If really, ultimately, illustrations are more of a form of advertising than it is actually a form of reality and expectations. And we'll get in later on in the week. We're going to talk a little bit about why we segregate the expense loads of a policy versus its actual performance, and we don't talk about them together. Because I think there's a distinction here. When you see why, you're going to say, this may change your planet and your understanding on why proposals work the way they do. An annual statement, now, it's going to give me kind of what happened in a digest summary format. I like it because it's quick, easy read. I can kind of look at it. I'm seeing the surrender charges, everything I need to know. When I put that on alongside of the in-force ledger, I have pretty much what occurred here, all right? But I still am not done. So talk a little bit about what am I adding to that now? What's the next due diligence process? What else do I need besides my annual statement and I have the old proposal, the one that it was written on, plus I have the in-force ledger.
Well, if this was any other asset on the client's balance sheet, it's important to know what you're being charged. But it's also important to know how that relates to everything else that's in a particular peer group, and everything else that would be suitable for that particular client.
Why is that important? Because I know this is a big core belief in you. Why do I need to compare to see what the rest of the industry is doing?
There's an 80% swing between best available rates and terms and worst available rates and terms. It is the widest swing in costs in any commonly purchased or commonly owned financial product that I'm aware of in the financial services industry. If you don't know what you're being charged and how it relates to the universal peer group alternatives, you have no idea whether you're being overcharged. And therein lies the sales opportunity. If clients don't know what they're being charged, or if the advisors of the best clients who want to do a good job of taking care of them don't know what their clients are being charged, you can go to them and offer, allow us to help you measure. Allow us to help you measure if you're being charged a fair price or if you're being overcharged. If you're being charged a fair price, I'll give you a third-party report that says you're being charged a fair price and I hope to be of service to you.
No, that's again comparing it to the average of the industry. Is that correct? I just want to make sure I'm hearing you correctly here.
Well, it's both. It's the average of the industry, but when you have a large enough database like we have, we can also calculate the standard deviation between or around that average to know where best available rates and terms are and where worst available rates and terms are. So in our reports, you can measure not only where are you relative to the average, but are you near that boundary? I said there's an 80% swing. So best available rates and terms in the entire marketplace before some of the underwriting considerations we talked about last night, but best available rates and terms are somewhere around 40% better than the average. If you're close to 40% better than the average on an in-force policy, then you have your client or that CPA's client is in good shape. If you're not close to 40%, then you have an opportunity to make an improvement. You have an opportunity to reduce what that client's being charged through a sales opportunity.
We come back from the break. I'm going to follow this up with Barry because I really want to talk about how you can measure this and what is really a deviation. When should I be concerned as an advisor? We'll be right back in about 30 seconds. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Welcome back to the second segment. Of course, I'm with Barry Flagg. We're talking about due diligence. And now I want to go down this line. Barry, you've seen, I don't know how many tens of thousands reports you guys have already generated. I want to know, do you think there's a great disparity in the vast majority of, I know this is a kind of hard question, but in the big picture of things, could this swing? You said 80%. I mean, I thought actuarial science was a science. We should all be in the game somewhat. Aren't we using the same numbers? Why would there be such a big, long and broad difference between one company and another?
Two reasons. And that, by the way, that 80% swing doesn't just come from our experience in our database. Tillinghast Towers Perrin published a study or released a study that was published in Trust and Estates magazine some years ago, concluding the same thing, about 40% on either side of the mean. A third-party administrator of trust-owned life insurance for institutions published another report. I think it was also published in Trust and Estates before that. So there is a big swing, not just because that's the experience in our database, but because there's a big swing, right? My thoughts on why there's a big swing is twofold. One, there are 10,000 different pricing combinations and permutations for every single product. And I didn't know this when I first started thinking in the embryonic stage of Veralytic, but between all the different age cells, times 2 for gender, times 3 or 5, as we were talking about last night, for health risk classification, times 2 or 3 more for tobacco use, if there's a never smoke risk class, times the volume breakpoints or the band. I mean, if you go through all the multiplications of how many different pricing combinations and permutations there are, there's just an awful lot of them. And no carrier is good at all of them. Some carriers have their sweet spots. Some carriers have their not so sweet spots. So there's just a lot of pricing combinations and permutations. The other reason, I call it the Adam Smith reason. Adam Smith says that for there to be an efficient market, there needs to be a free flow of information. So yes, there are a lot of actuaries, but the invisible hand of the consumer in the current environment doesn't get to pick good pricing.
Well, let's go drop it to the advisor level because I think that's where we need to start. How many advisors know that?
What their clients are being charged?
Sure, and also these issues of, hey, am I getting a good deal? Am I off the bell curve? Do I get that, and do I understand that when I'm pricing my product?
I'm sitting here today because I started at 19 years old using Morningstar, and it was so easy to look stuff up. Well, if you think about before Morningstar, to try to get an answer in the investment, an answer that is commonplace now in the investment business, you would have had to pull out 1,700 prospectuses, read them all, compile them all into a spreadsheet, and then it was impossible. Right? So prior to the first of our patents, it was, as a practical matter, impossible to do what we're talking about today. But as we have also said, Veralytic is one of a number of tools that are available to help the practitioner do real due diligence in the sense that CPAs, tax attorneys, and trust officers think about it, it was not possible before.
Well, when you think about all the permutations you just were giving me, I mean, I'm thinking of the subsets of gender, underwriting, the pricing of, does the pricing of term, is it differing from my universal life chassis? Answer yes. And the big bugaboo, which of course you've heard me talk about before, which is, I don't even know how to unpack whole life, because it's the black box. Universal life, I can ask for the report, I can kind of get in the game, has a pretty good idea, get a good feel. But on whole life, it's like it's this homogeneous, integrated, I can't pull it apart. But you said, and we might get, if we have time at the end of the week, we may get into this. Whole life, there is a way to re-engineer it, kind of not back re-engineer it, to try to somehow unpack it by reverse engineering it.
Yeah. I mean, the same algorithms that we use to convert, our first patent was on the conversion of disparate units of measure into a common unit of measure. Those same algorithms that are used to convert COIs, which are expressed differently than premium loads that are expressed differently than cash value-based charges, to convert, we use those same algorithms to calculate, to separate the cost inside a life insurance policy, not into their discrete elements, because they're not disclosed that way. So, but we were able to calculate the costs inside the whole life policy separate from the performance assumptions. And then once we have the costs, we can then measure those costs against everything else in the database.
So you can get in the game at least, kind of understand what's going on. I think that would be a huge issue. I mean, I know of the quest to know what's in the black box of participating whole life as a product has been a 30-year search, and I don't see seen anybody actually get to it. So that would be a huge issue. When I think about some of the ideas that are going on now, especially with pricing, and we're living longer, and that means the numbers are, at least right now, they seem to be coming down. Do you see this still happening? I mean, do you see any light at the end of the tunnel? Are we leveling off, or no? That we're going to be living much longer, and those numbers are probably going to come down, and that's why we need to review it.
So even though people are living longer, the contract duration is now spread out so much longer that if you were to fund a policy to mature to age 100 under the old table, it would probably take less premium, depending upon the rate of return that would be reasonable to expect. But it could take less premium than a policy funded to mature at age 120. So, which is counterintuitive. If people are living longer, that should be a lower premium because the insurance company has more time to not have to pay that claim. But because of the new actuarial table, you've got the longevity is making things less expensive, but the funding to maturity, which I don't think too many advisors actually do, but the funding to maturity actually makes it more expensive to carry that coverage all the way to age 120.
Well, we're going to be looking at all this week to give some kind of measurement and try to quantify what we're actually selling, so we at least as advisors know what we're talking about. That's all the time we have today for today's show. Remember, before moving forward with anything you hear on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. And don't forget, you can view any of our past episodes at downtobusiness.ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. We'll see you.